Stop scrolling, stop zooming in on the price chart like the next 5-minute candle is going to save your future. Stop refreshing your feed hoping for a clean number 96, 90, 100, because what I am about to show you has nothing to do with the number on your screen and everything to do with whether the market still functions. At all, because here's the uncomfortable truth. A market can quote a price and still be dead, a market can look open and still be frozen, and as you're watching this as wholesale silver pipeline is showing signs of a hard seizure, an event that doesn't feel like a normal shortage, doesn't look like a normal squeeze, and absolutely does not behave like anything most investors have lived through. Now listen quickly. My analytics say a huge chunk of you watch every upload, but you're not subscribed. If this channel has ever helped you see around a corner, hit subscribe right now and drop a quick comment, even just our John AG, so the algorithm knows this community is real. Alright, take a breath. Because we're going to walk through what's happening, why it's happening, and what it means for the people holding physical, the people holding paper, and the dealers who sit in the middle trying not to get crushed. And yes, I'm going to keep this practical, no theory, no fantasies, just the plumbing, the part nobody talks about until it breaks. Here's the headline in plain English. Liquidity is not the same thing as demand. A shortage means people want product and the system is still moving, just slower. A liquidity freeze means the system can't move at all, even if people are screaming and waving cash. And that distinction matters because I've seen something that signals freeze, not shortage. Over the last day, internal wholesale availability sheets, what many dealers call the morning menu, started coming through with a pattern that should make your stomach tighten. For those new here, this is the basic chain. At the bottom is you and me, the retail buyer, the stacker, the person trying to protect purchasing power. Above us are local coin shops and regional brokers. Above them are the big online bullion dealers, and at the very top right next to the government supply are the authorized purchasers and major wholesalers, the only firms that can reliably source large volumes, and in some cases buy directly from sovereign mints. These top-tier wholesalers are not a side story, they are the heart. Pump, when they're functioning, metal flows. When they stall, everything downstream starves. Normally, these firms publish a sheet with thousands of lines, eagles, maples, kilobars, 100-ounce bars, generic rounds, industrial bars, and more. Next to each line, you see two numbers. A bid, the price they will pay to buy metal back, and ask, the price they will sell at to dealers. That simple two-column structure is the proof the market is alive. It's the proof there is a buyer and a seller. It's the oxygen. And then you open the sheet, and you see the worst two words in a market. No bid. Let me slow that down because it's easy to miss when the ask side starts turning into not available and sold out. You think, okay, demand is hot, tight supply, premiums rise. Painful, but the system is still moving. But when the bid side turns into no bid, that is not tight, that is a seizure, that is the buy button being shut off, and that's what we're staring at. Products that cannot be ordered, and metal that cannot be sold back at the same time. So let's talk about what this looked like in real terms. On the sell side, line after line went dark. American Silver Eagles, unavailable, delivery dates unknown, generic rounds removed, large bars, back order with no confirmation, even the stuff that normally never disappears, basic wholesale blocks, was either marked sold out or pulled entirely. Now, if the story ended there, we'd call it a but the other side of the sheet is what changes the entire narrative. Because when dealers can't keep shelves stocked, they usually do the one thing healthy markets do. They bid up, they compete for supply, they pay more to attract metal. You've seen it before. We pay 5 over spot for your bars. We pay above spot for eagles. That's the system solving its own problem. But when the sheet says no bid, the message is, we are not buying, not even at a higher premium, not even if you show up with pallets. Picture this. A local shop calls the wholesaler and says, I have a customer with serious money ready to buy right now. What can you ship? The wholesaler says nothing. So the shop says, okay, but I can sell you back inventory. I can send you bars and rounds today. And the wholesaler says, we're not bidding. And that is a paradox in a normal world, sold out but refusing supply, desperate but not buying. How? And here is the answer that most people don't want to accept because it reveals how fragile the system really is. This is not primarily a silver problem. It's a money problem. It's not the absence of metal that's doing the damage. It's the absence of liquidity, working capital, credit capacity, and the ability to settle. The wholesale hubs are not saying we don't want silver, they're saying we can't fund it. And if you've ever run any inventory business, you understand the difference immediately. You can be on paper and still fail because cash flow is oxygen. Without it, you don't operate. So what's choking their oxygen? The hedge. And I know some of you just rolled your eyes because hedging sounds like finance bro talk. But stay with me because this is where the trap snaps shut. A big wholesaler is not trying to gamble on price direction. Their job is to move metal, not speculate. They buy at a small premium and sell at a slightly bigger premium. They live off spread and volume. The price level matters less than the ability to keep product moving, but to hold large inventory without getting destroyed by a sudden drop. They typically hedge. They buy physical, then they sell futures against it. That short futures position is supposed to offset the inventory risk. If silver falls, the physical loses value, but the short futures gains. Net neutral. That works in calm markets. It works in grinding ranges. It even works in many downturns. But when price goes vertical, the hedge becomes a cash drain machine because futures are marked to market daily. The exchange doesn't care that you have physical sitting in a warehouse. It wants cash for the loss on your short position today, not later. So let's build a simple example, not because the numbers are perfect, but because the mechanism is a dealer accumulates a large physical position when silver is far lower. They hedge by shorting futures at that level and silver surges. Yes, their physical inventory is worth more on paper, but their hedge is losing and the futures market will demand margin cash to cover that loss. That margin isn't paid in silver. It's paid in dollars and it's paid fast. So the dealer is sitting on an appreciating asset and simultaneously bleeding cash they need to operate. When the move is modest, they fund it from working capital or a credit line. When the move is violent, the daily margin calls can become monstrous. That is when the credit lines matter. Because the dealer doesn't have a giant pile of free cash sitting around. Their cash is tied up in inventory and operations, so they lean on revolving credit facilities with banks. Those lines are designed for normal stress, not for a runaway melt-up. And when the move overwhelms the line, the dealer hits a wall and that wall looks like this. The wholesaler stops bidding, stops buying, stops funding inventory, because every available dollar is being sucked into margin. So you end up with the nightmare condition sold out because demand is intense, but no bid because capital is exhausted. That is how a market becomes a zombie market. Lights on, quotes printing, but the bridge between buyers and sellers has collapsed. Now here's the part you need to sit with. Once the bridge collapses at the wholesale level, the downstream effects don't arrive slowly. They hit like a chain reaction. Local shops can't restock, so they shrink hours or close temporarily. Online dealers can't hedge properly. So spreads widen, delays grow, and sometimes out of stock becomes the default. People panic and panic does what it always does. It pulls product off the market, because when someone believes replacement will be impossible, they stop being a seller at any price, and that's when the price on the screen becomes an illusion. It becomes a number that exists in a paper arena while the physical market is playing a different game. Now, before we go deeper, two quick things for those who want daily updates beyond YouTube. First, I've set up a WhatsApp channel where I drop daily posts, quick breakdowns, and personal analysis that I don't always put on YouTube. Plus instant voice notes when something hits fast. The link is in the description. Join it if you want the real-time layer. Second, by the time you're watching this, a members-only video should already be live. One single video that bundles the latest developments and goes deeper than I can in a public upload. If you want that and you want to show me you're really following, consider joining the membership. Alright. Back to the fire. At this point you might be thinking, okay John, but if wholesalers are sitting on metal, why not just sell some to raise cash and keep operating? Great question, and the answer is, where the trap gets uglier. Because if the wholesaler sells physical inventory, they also have to manage the hedge side. To unwind the hedge, you buy back the futures short. In a soaring market, buying back that short locks in the loss. So yes, the physical sale raises cash, but the hedge unwind consumes cash. And the net effect may not relieve the pressure enough, especially if the move has been fast and funding is already maxed. It is like trying to bail water out of a sinking boat with a cup while the hole in the hull is still open. Now here's what makes this moment different from a normal high-premium environment in normal times. The US market is anchored by deep liquidity, dealers and wholesalers freely buying and selling. Even when supply is tight, money can move the metal, but in a liquidity freeze, the US market becomes self-isolating. Metal doesn't circulate, it gets stuck, and when metal gets stuck in the West, it does something else, it gets pulled east. This is where the story shifts to the part most people haven't processed yet, global price. Discovery is starting to leak away from New York. Because while us wholesalers are choking on margin and credit, other markets are paying up and paying cash. One of those markets is India, and I want you to listen carefully because this is the kind of detail that tells you whether the center of gravity is moving. In India's major commodity exchange ecosystem, silver has been printing levels that make the US quote look like an old memory. Convert the local pricing and the implied per ounce level has been materially higher than what many Americans see as the price. Now, here's the obvious question. If a refiner can sell a bar into a market that pays significantly more, why would they ship it into a market that's frozen and underbidding? They wouldn't. Metal flows toward the highest real price, especially when that price is backed by immediate settlement and delivery. So the Western liquidity freeze isn't just a domestic issue. It is an invitation for the rest of the world to vacuum the physical supply away from the paper anchor. And when that happens, it creates a feedback loop that makes the freeze worse. Less inbound metal means wholesalers stay empty. Wholesalers staying empty means retail premiums stay high and availability stays low. High stress triggers hoarding. Hoarding reduces supply further, and the loop tightens. Now I want to pause here and throw you two questions, because your answers in the comments tell me where this community stands. First, if you had to choose right now, physical in hand or paper claim with liquidity, which one do you trust more today and why? Second, do you believe the real price is the one on the futures screen or the one where people are actually taking delivery? Tell me your reasoning, drop your answers below. And if you're doing well financially, if you've had a win in business, investing, or even just getting your budget under control, share a line about it in the comments. People need to see real success stories, not just headlines. Now let's connect the dots to the futures market, because this is where the story gets even more explosive. For weeks, a common strategy in futures is to roll contracts, push exposure forward to a later month to avoid standing for delivery. It's a way to keep the paper game going without pulling metal out of vaults. But when participants stop rolling and start demanding bars, it reveals a shift in psychology. Trust is fading, and recent delivery data has been flashing that change. Instead of contracts quietly rolling forward, a heavier portion has been leaning into delivery behavior, especially in months that are normally quieter. That matters because the futures market is the reference price mechanism. When physical demand begins to stress that mechanism, the whole structure becomes unstable. And yes, you will hear people say it's normal, it's seasonal, it's routine. But I want you to ask yourself a simple question. If everything is normal, why are wholesalers showing no bid? If everything is normal, why are spreads widening? If everything is normal, why are other regions paying a materially higher implied price? If everything is normal, why are investors increasingly acting like they don't trust future promises? The behavior is the signal. Now we can talk about banks without turning this into a sometimes through house accounts, sometimes through client flows. But when one entity repeatedly appears as a major stopper, meaning they're taking possession, it suggests accumulation. And accumulation during stress is not random. It means someone with deep pockets is positioning for physical scarcity, not paper convenience. So while wholesalers choke, the strong hands consolidate. And here's where the capital crisis label earns its name, because the people who are weak in this moment are not the ones holding metal. The weak are the ones caught between metal and dollars. They need dollars to settle margins. They need dollars to buy inventory. They need dollars to run the machine. And the very thing silver is doing, rising against the dollar, is destroying the ability of dollar-based plumbing to keep that machine moving. This is the irony. Most people miss. The dealer is in the silver business, but their survival is tied to dollar liquidity. So when silver screams higher, it can actually kill the dealer even as it rewards the holder. That's why you'll sometimes see a strange psychological conflict. The customer cheers for higher prices, while the dealer secretly prays for a pullback, not because they hate silver, but because they need breathing room in credit and margin. Now I promised you cliffhangers, so here's one. If the West is freezing and the East is paying up, what do you think happens when the next wave of industrial demand hits? Solar, electronics, defense, medical? At the same time, retail buyers are refusing to sell. Because that's the kind of alignment that breaks paper models, and we are not far from that scenario. Now let's go one layer deeper into the mechanics, because this is how you understand why no bid is such a terrifying phrase. A market at its core needs continuous two-way flow. If you can buy but can't sell, it's not a market, it's a trap. If you can sell but can't buy, it's not a market, it's an auction. If you can neither buy nor sell at scale, it's a freeze. And in a freeze, price discovery becomes distorted. It becomes location dependent. so you may see a futures quote, a retail premium, an overseas benchmark, and private transaction prices all diverging. That divergence is not just noise, it is the signature of structural stress. Now let's tie this back to a simple reality for you watching. If you own paper exposure, an ETF, a pool account, and an allocated claim, you're trusting a chain of counterparties. You're trusting that the custodian has what they say they have. You're trusting that redemption terms won't change. You're trusting that settlement will be smooth in stress. You're trusting that liquidity will exist when you need it most. And I'm not here to tell you what to do. I'm here to tell you what the system is signaling. When wholesalers post no bid, they're telling you liquidity is conditional. When overseas pricing runs above domestic reference, they're telling you price discovery is shifting. When futures delivery appetite rises in unexpected months, they're telling you trust is fading. And when banks and strong hands appear to be accumulating physical, they're telling you the game is moving from paper to possession. Now let's address the biggest mistake people make at moments like this. They assume things will normalize. They assume the spreads will narrow, supply will appear, and credit will loosen because it always does. But history shows that when financial plumbing breaks, it rarely returns to the old shape. It gets rebuilt differently. Sometimes the rebuild looks like consolidation. Fewer dealers, fewer wholesalers, bigger players. Sometimes it looks like rule changes, new margin requirements, tighter settlement windows, altered contract terms. Sometimes it looks like a slow nationalization of supply, governments prioritizing industrial needs. And sometimes it looks like the simplest outcome of all, the physical price detaches and the paper price becomes irrelevant. Now I want to rewind the clock for 10 seconds and show you how fast this kind of thing spreads, because many people hear wholesale and think it is some distant world that never touches their life. That's a mistake. When the top tier locks up, it hits your street in a matter of hours. It starts with a simple change on a dealer's website, call for availability. Then it becomes limit to per customer. Then it becomes we're only selling to existing clients. Then it becomes we are temporarily suspending buybacks. And then one day, you walk into a shop and the display looks normal, but the owner's eyes don't. He's smiling, he's joking. But he is guarding what he has like it is the last clean water in the desert, because behind the counter he knows he can't replace inventory at any price he can safely quote you. That is the moment the retail buyer misreads the situation. They say, oh, the shop still has metal, no big deal. But what they don't see is the shop's restock channel is broken. And if you don't understand that, you make the most common mistake in a freeze. You assume supply exists because you can still see a few items. That's like seeing a gas station with 2 pumps working and concluding the refinery is fine. It isn't. Now let's talk about spreads, because spreads are the market's pain meter. Income periods, spreads are narrow. Dealers can confidently price product because they can replace it quickly and hedge it easily. In stress, spreads widen, not because dealers are greedy, but because replacement risk is rising minute by minute. When a dealer sells you a bar today, they are short that bar until they can restock. If restock is uncertain, the dealer must price that uncertainty. So spreads widen, premiums rise, and buybacks get cautious. And when no bid appears upstream, downstream dealers either stop buying or they offer you a price so low you think they are insulting you. They aren't insulting you. They are protecting themselves from a market where they might not be able to move that metal into the wholesale channel. Now here's a brutal but useful concept in a liquidity freeze. Bid becomes more important than ask. Everyone loves to talk about what they can buy for. Almost nobody talks about what they can sell for in a crisis. If you need to liquidate for an emergency, job loss, medical issue, family problem, your experience is determined by the bid. That's why no bid is such a serious warning. It tells you the exit door is narrowing, not for the physical holder long term, but for anyone who might need quick conversion back to cash. And this is where your personal strategy matters. If you are stacking as insurance, you don't sell insurance because the premium went up. If you are trading, you must understand the difference between a liquid market and a market that only pretends to be liquid. Now let me connect these two paper products in the most practical way I can. Paper exposure feels comfortable because you can click sell in 1 second, but that comfort is built on the assumption that the structure behind the click remains intact. If the structure breaks, your click gives you dollars. Yes, but the question becomes, what will those dollars buy? Because in a freeze, the problem isn't always, I can't sell. The problem is, I can't replace. So some investors will sell paper, see a nice profit, and then discover the physical market has moved to a different planet. They will discover the premium is not $5, it's $20, it's $30, it's callous, it's waitlist. And that's when paper profits start feeling like monopoly money. Now let's get even more specific about the futures piece because people hear delivery and assume it is a myth. Delivery is real, but it's not simple. It's a chess match. Most contracts never deliver because participants close positions or roll, but in times of distrust, more players choose to stand. Standing is a statement. It says, I don't want paper exposure anymore. I want the bar. And when that happens in months that normally don't see it, it tells you that psychology has shifted. So if you're watching the market right now, don't only watch price. Watch open interest behavior. Watch delivery notices. Watch whether participants are rolling forward or staying put, because those patterns reveal whether the system believes in the future. Now, if February, normally a quieter month, sees an unusually stubborn open interest into first notice, that would be another stress marker, not because the exact number is magical, but because the behavior is. It would mean the desire for possession is spreading across the calendar, and that has two consequences. 1. It drains available vault inventory faster. 2. It forces the exchange ecosystem to choose between physical settlement and alternative settlement, and when alternative settlement becomes more common, cash offsets incentives. Confidence erodes further. Now, I'm not saying that happens tomorrow. I'm saying this is the direction the incentives push when physical becomes scarce and trust becomes thin. Now, let's take another step into global arbitrage, because this is where smart money moves quietly. If one region prints a higher real price and has a culture that prefers taking delivery, metal will flow there. It's not political, it's not emotional, it's profit and survival. Refiners, fabricators, and traders will route supply too. The markets that pay more and settle faster, and when that happens, the benchmark market loses its power, because a benchmark that cannot source physical becomes a reference, not a reality. Now think about what that means for the United States. If the US wholesale channel is credit limited, it cannot compete for incoming physical at higher global prices. So US dealers are forced to ration. They limit quantities. They prioritize certain clients. They raise premiums. They slow buybacks. And eventually, they may do something even more drastic. They may shift to consignment models, where they only sell what they already have and avoid taking inventory risk. That sounds technical, but it's simple. The dealer becomes a broker, not a warehouse. Now, I want you to imagine how that affects the average buyer. You go from a world where you can buy any day, any time at a predictable premium, to a world where you need to be early, connected, and patient. That is not a market that serves the public. That is a market that serves insiders. And this is why when I say the chart is becoming less important, I mean access is becoming the real story. Now let's talk about one more mechanism that can tighten the news: collateral calls. Banks don't just look at futures margin, they look at overall exposure. When volatility spikes, risk departments tighten. They ask for more collateral, they reduce credit. They shorten settlement windows. So even if a wholesaler is technically solvent, the bank can effectively choke them by demanding more security. And if the wholesaler can't meet that demand quickly, the bank freezes expansion and in extreme cases, takes control of inventory that was pledged. That's not drama, that's how secured lending works. Now I want to be clear. This is not me telling you the system ends tomorrow. This is me telling you the incentives have flipped. For decades, paper market could set the tone because physical was abundant enough and credit was cheap enough to keep the bridge standing. In a world of higher prices, higher volatility, and tighter credit, that bridge is not guaranteed. And when it cracks, you see exactly what we're seeing. Sold out, no bid on the same day. Now let's bring it back to you again with a practical checklist, because information without action is just stress. Here's what you watch this week. Watch whether your favorite dealers reopen buybacks normally, or whether they stay selective. Watch whether backorder dates become real shipping dates. Watch whether premiums compress or keep widening. Watch whether call for availability becomes the default. Watch whether global premiums remain elevated or whether the gap closes. And watch whether the headlines try to distract you with, it's just rebalancing, it's just seasonal, it's just retail hype, because mainstream explanations often arrive after the event, and they rarely talk about credit. Now, a word to the people who are new and feel overwhelmed: don't let the noise push you into dumb decisions. If you already own physical and you don't need to sell, your job is patience and clarity. If you're trying to build a position, don't chase blindly, build with a plan and understand that availability comes in waves. If you're sitting on paper and you're unsure about counterparty risk, study your product's terms and decide what you actually own, a claim or metal. Now, one more community note, because this matters more than you think. If you're successful, if you've built a business, found a strategy, or simply turned your financial life around, Drop a comment about what worked for you. Even one sentence. People learn more from a real person's path than from 1,000 hot takes. Now we're going to land the plane, but I want to leave you with the most important cliffhanger of this entire video. If the wholesalers are maxed on credit, and if the physical flows east, and if futures participants start demanding more delivery, what happens the day industrial buyers decide they can't risk just-in-time anymore? What happens when manufacturers start building inventory buffers? Because that one behavioral shift can turn a tight market into a violent market, and that's why the next few weeks matter. Now let's address the elephant. Will the banks step in and fix it? Banks don't fix markets out of kindness, they fix markets to protect themselves. If a dealer fails, banks seize collateral. If a wholesaler collapses, their inventory becomes an asset to be acquired. So a crisis can look like a rescue, but functionally it is often a transfer. And transfers are what happen when weak hands must sell and strong hands can wait. That's why in moments like this, the wrong question is, will this go back to normal? The right question is, who is positioned to benefit from the new normal? Now, I want to make this personal for you. If you've been stacking, saving, investing, building a side business, whatever your path is, this is exactly the type of macro stress where discipline pays. But discipline doesn't mean silence. If you've had a win, big or small, tell people in the comments, it matters. You never know who's watching and ready to quit. Now we're nearing the verdict, but I need you to understand what the phrase, price becomes irrelevant, actually means. It doesn't mean price doesn't matter. It means the reference price loses authority. In a freeze, you can quote a price all day, but if you can't transact at scale, the quote is theater. The real price becomes the one where supply meets demand with settlement and delivery. That's why fragmented markets are dangerous and revealing. Now let me give you a final visual. Imagine a bridge between two islands. Island 1 is buyers with cash. Island 2 is sellers with metal. The bridge is wholesalers and dealers backed by credit lines and hedging. In normal times, the bridge carries constant traffic. In a liquidity freeze, the bridge collapses. Buyers and sellers still exist, but they can't reach each other through the old route. So they build new routes, direct deals, overseas sourcing, private networks, higher premiums, and a shift in who sets the benchmark. That's what's happening. And when the new routes form, the old gatekeepers lose control. Now here's the verdict, and I'm going to be careful and direct. The US wholesale silver market is flashing a liquidity event, not merely a supply hiccup. The evidence is not just sold out, it's no bid. Plus, the risk is not just premium pain, it's settlement stress. The big implication is not just higher price, it's price discovery moving. So what do I want you to do right now? Subscribe if you haven't. Join the WhatsApp channel if you want daily analysis and instant updates. Consider the membership if you want the full consolidated members-only briefing. And most importantly, think in terms of systems, not candles. Because a candle can lie, but a broken supply chain cannot. I'm John A.G., and I'm telling you, when the plumbing breaks, the real story is not the chart. It's the freeze behind the chart, and the next phase of this is going to surprise a lot of people who thought they were watching a normal bull market.